And I'm joined today by Lucas Markou, Director of Jerroms, and Pete Miller, Director and Head of Tax of Jerroms Miller, Head of Corporate Tax of Jerroms Miller. So we are here to talk about our immediate thoughts about the autumn statement, which we were all eagerly watching today, and perhaps some of us have been somewhat let down by what could have been some interesting predictions that we had. Underwhelmed. That's a good word. I like that very much. So, as we go through, we'll talk about the various topics that were raised in the statement, and also many of the ones that we thought might be raised and are not, or were not raised. There's a number of platforms that we are streaming on, including LinkedIn. Anybody who wishes to contribute, if you comment on LinkedIn, we'll be able to see those comments through our platform, and we can respond. And yeah, the more people to comment, hopefully the more lively the discussion will be in an underwhelming budget, shall we say. So where shall we start? As Pete and I do corporate, shall we start with corporate?
I think we probably could, yeah. What did you think, Nick?
I was trying to think, what were the exciting things? Right, so the first thing was we've now got full expensing made permanent. We already had full expensing. In a sense, it's a good thing because now it's effectively a first-year allowance for capital investment. And Pete and I did, some of you might have been watching on Friday, we did a predictions podcast where I discussed capital allowances, and we'll come up with our predictions at the end, but I don't think we really thought there were going to be much reform to capital allowances. The one thing I said was, please rename full expensing, which they do not appear to have done. So what is full expensing? Because it's nothing to do with the P&L. If you're thinking that it means you can put your capital asset additions through the P&L, that is not what it means. All it means is that we can now have 100% relief in the year of acquisition. So they still sit on your balance sheet for accounting purposes. That had already been announced in April 23, I think it was announced, or at least it came in from April 23, and they've now made it permanent.
Which, to some extent, I mean, I don't really see as a major change. You know, in the world of sort of especially short-lived tax reliefs to try and stimulate the economy, a 3-year time horizon is as long as it gets, especially when we know there's got to be an election within what's now about 15 months. Yeah. So, you know, to say it's gone from a 3-year timeline to no deadline or no sunset clause, as it were, really is largely meaningless, because the question of whether it continues in place in that form or as some kind of enhanced first-year allowance or whatever is going to be down to the next government, whatever complexion that government takes. So, I mean, in a way, I feel it's like they just announced something. You could be very cynical and say they announced it in March with a 3-year time window so that they could get back up on the podium today and announce that they've extended it from 3 years to forever, as though that was in any way meaningful, you know.
Lucas, you deal with a lot of, obviously, accounts, and you're director in Jerroms, so you deal with lots of accounts and audit clients. Really, how many of these are affected? Because there are some big clients out there that make a lot of capital additions in the year, but we've got an AIA that has £1 million anyway. The full expensing only applies to new assets. I think when Matt, one of our colleagues, was saying he read something that 97% of people don't spend over £1 million anyway.
Yeah, you notice that Jeremy Hunt, when he statement, he mentioned the very large companies, international companies, were going to really, benefit from this, and that's probably, that's what saying that reality. Some people might say it's a bit of a soundbite, 97% are really unaffected. But he can say that it's the biggest ever boost for business investment in modern time, which
in terms of the fact that it might stimulate some foreign direct investment and therefore jobs, yes, as a measure for British business, as in the self-employed, the SMEs that are our lifeblood, I'm not sure it does a great deal.
No, I agree.
Anyway, nevertheless, it's better to have it than not have it, I guess, if I could try and put a positive gloss on it, which is contrary to my normal nature.
Other major thing for companies is R&D. I'm saying major thing because it's the major headline within a list of maybe not so major points. But I think certainly for the R&D advisors out there, there's some changes coming that, I mean, personally, from what I've seen people saying already in sort of LinkedIn and places like that, I'm not sure that this is in any way a simplification. What they're saying we're simplifying R&D because we're merging an SME and an RDEC scheme, but actually what they're saying is we're getting rid of an SME scheme and moving to an RDEC scheme, which is, I think most people who deal with R&D would say the RDEC scheme is a more complex scheme anyway.
Well, yes, and there's still going to be a special scheme for SMEs for those that are R&D rich, or whatever the phrase is, intensive. That's right.
So the RDEC, it's above the line credit. It's all about, these FTSE companies being able to identify what's saving there is some R&D. When the SMEs are not really concerned about where it appears in the P&L, the accounts. It's all about the real cost.
Yes. Yeah, and I think we were talking about this a while ago about actually R&D relief is largely the policy of R&D is to bring in more investment into the economy and perhaps actually more foreign investment.
Well, I think that's very much the point. I mean, if you go back to late last century, make myself sound very old.
How was it?
Yeah. Okay. Yeah. Well, we just got running water and gas lighting in the house, so it was nice. That was all came out of research and development, you see. But in all seriousness, that was exactly it. In the early noughties, it was all about making the UK a competitive place to do business. So we had R&D, we had this substantial shareholding exemption, the corporate intangibles regime, which is eviscerated 15 years later. But the point is that when you say you want to make the UK a good place to do business, what you're really saying is you want people to come here to do business. And I've seen an awful lot of people claiming an awful lot of tax back or tax savings using the R&D scheme who would have done that amount of R&D in this country anyway. So there may be a marginal impact on people who were already here. But, somebody who was born and brought up, for example, here in Solihull, where our offices are, and is operating on one of the business parks, isn't suddenly going to say, I'm going to up sticks and go to Belize because they have a fantastic R&D tax regime. So this really is about the big multinationals, should I say, putting some of their R&D function into the UK. Whether it has any impact at all anyway is a completely different story. And I've seen academic papers that put the actual tax system about 6th or 7th on the list of top 10 priorities in terms of where do we put our R&D. So it's as wide as it's long.
And the other thing, I don't deal with R&D day to day, but the other thing, talking to some R&D specialists, is the changes that have been proposed, the admin side of things is not getting easier either.
No, well, a lot of those came in March, didn't they?
Yeah.
Like the requirement to sort of pre-register that you're going to make a claim.
Yes. There's further changes in the statement.
Yeah. Well, wasn't there something about a difference in the way in which the compliance is now dealt with?
Yes.
Which, given what has been happening for the last 6 to 8 months or so, fills me with an intense sense of foreboding. And I also don't deal with R&D, but it just makes it difficult when you're sitting down with people who do R&D and to say, you should make this claim, because they go, I've heard that basically as soon as you make a claim, you're accused of fraud by HMRC, which is basically true.
Yeah. And we've got a lot of clients, not necessarily done R&D with us, but there's plenty of clients who are receiving inquiries now, aren't there?
So it's legitimate claims. Because HMRC seem to start with the starting point that it's not a valid claim, and it's almost you to prove that it is, rather than kind of proving it.
But those claims are accompanied with the report that proves that it's real, and it's clear these people are not reading it. I mean, it's interesting because one of my chums, that I'm involved with various institute CIOT committees, and one of my chums on the corporate committee, which kind of looks after things like the R&D issues, it became aware of a firm where having had this knockback with the revenue basically saying, nope, you can't have it, and the client saying, fine, you amended my return, I refuse the amendment. They promptly made a claim to the High Court for payment of the R&D tax credit, I think it was. And basically they were able to do this because I'm not quite sure procedurally, but they were able to sort of demonstrate that going through the tribunal was not the way forward. And literally, as soon as the papers were lodged with the High Court, the revenue caved in, and the relevant sort of solicitor acting for HMRC said he would instruct HMRC to make full payment immediately. So I think, business is pushing back, but something that was meant to make the UK a good place to do business is now in a relief where if you claim it, you're accused of fraud, regardless of how legitimate your claim. That's just because HMRC is utterly incompetent in this area.
Also, they've thrown lots of manpower without experience at it. Or training. Yeah.
Or even, but the point is these people haven't even read the revenues manuals that say how they will deal with R&D claims, or indeed read the actual reports. Anyway, that's not really part of the budget, but it's all very well saying we're doing things to R&D, we're making it better, we're making it simpler, not, we're making it more friendly, equally not. But actually the practical reality is people, and those inward investors are choosing not to come here or are leaving because of some of HMRC's current behaviour. So it's almost as though, having done nothing compliance-wise for 20 years, the pendulum swung completely the other way, and they might as well abolish the relief if they're going to act like this.
Yeah, I don't think I saw a single R&D inquiry up until about 12 months.
Yeah, exactly.
Okay, so I think they're kind of the two big things, talking points in corporate tax. There's a couple of other smaller things, some that might affect, with Jerroms being a Midlands-based business. Some Jerroms clients might be affected by new investment zones. They've announced one in the East Midlands and one in the West Midlands, and another in Greater Manchester, wasn't there?
Yeah.
So whether some clients might be able to take advantage of that. Otherwise, the headline is there are no changes. So no changes to CT rates. We've still got coming in a small rate limit of £50,000, where if your taxable profits are below £50,000, you'll pay 19%. If they're above 250,000, you'll pay 25%. Moving on to some.
I suppose just before we move on to the other things we were looking at, it's worth noting that the one thing we expected, I'm not sure if it fully comes in under corporate tax, but it's something that we would deal with in that arena, is the sort of sale to EOT stuff. That we know that there's been a lengthy consultation. Absolutely no announcements were made today, neither in the House nor on either of the Treasury or HMRC websites. So we'll assume either that they're putting off any announcements till the new year, which wouldn't be unreasonable because I think the consultation period ended in September, didn't it? So it gives them, so it gives them 3 or 4 months, but they've only maybe had a couple of months so far to actually review the comments and consider the things that ministers might choose
that
to
was
do.
my main thing was, have they really had long enough to make any real changes? Although I did hope there were some minor things in there that could be done fairly easily, like not being able to use offshore trusts and increasing that income tax-free bonus. But
I think they probably want to announce the whole package in one go, and with effect from, let's say, sales into an EOT from 1 April. And maybe part of that would also involve them saying, well, if we sort of half-assed announced it today, then would people say, well, actually, since the rest of the changes are not coming in for a while, we'll hang on.
True.
And you end up with a dip of sales into EOTs because people are waiting for the promised changes, as it were. So we'll wait and see anyway. Nothing was said today, so it's not really worth speculating as to why not. Just thought it's worth noting that it didn't happen.
Yeah, and actually maybe it benefits some who do have offshore trusts and therefore don't have to worry about it until the next statement that we have.
Oh, yeah, fair enough.
IR35, there's been a slight change there. I wouldn't say it's any headline grabbing changes, but effectively what they've done is say PAY liability, which the new rules have IR35 say that the person who would be the employer, if this was an employment relationship, they have to deduct PAYE from the payments they make. The slight change that we've got is that the deemed employer can now deduct tax that would be paid by the worker.
Or has been paid.
Yeah. Before you did the agreement of the worker, when you look at an offset, and there's always a worry there. So this, I think, has been discussed for some time about this coming in. It's good to know this actually.
I think trying to stay positive. I think this is a good change, and yeah, I think it will help cash flow as well for the businesses involved. So, although most of the time when we're involved in IR35, it's am I outside of IR35, and if not, restructure rather than get caught by IR35.
We're successful with ours anyway.
Business rates. That's a slight. Not sure how excited I ever get with business rates, being a corporate tax advisor, but business rates is another. Is it a change? It's not really a change. It's just that they've extended it for another year.
Which is massively important for
businesses
in those kind of difficult sectors with kind of light and heat going up and wage increases, and obviously food costs going up. Hospitality, hospitality difficult time. So,
and I think a 1 year extension is actually more meaningful in a funny sort of way than lifting the limit altogether, because you're saying, look, even if there were an election in May, it's unlikely that an incoming government would then accelerate any change they might have in mind. So a 1 year extension to the current business rates regime or relief regime would actually allow you to plan accordingly. That would be genuine.
We've been positive. You thought it.
Yeah, it's not my normal way of being, but I have an audience. I have to pretend they want me to be positive.
Again, we're kind of racing through this because the changes are fairly minor in most cases. But if we talk about how employees have been affected by this budget, we've got the national living wage that's gone up
substantially.
That's quite substantial.
I mean, it does genuinely recognise the rate of inflation over the last few months.
So it's gone up to £11.44, which I think equates to something like 22,000 a year.
Yeah, but he also pointed out that this was something like a 7.5% or 8% increase. Yeah.
I think that's I wrote that down, but yeah, it's gone up by at least £1, I think. Up to £11.44. So,
but I think the next bullet point is absolutely huge. The national insurance contribution cuts. Because in a way, national insurance has been a little bit of a stealth tax. I remember the first time in my memory that the rate was increased, which is probably 15 years or so ago now. We're just coming into the modern era. The dinosaurs have died out now, Lucas. Except for the odd ankylosaur that's just guarding the car park, But in all seriousness, it sort of was one of those things that I think it was around 9-point-something%, and then the Chancellor said, we need to raise some cash. We'll just put a penny on it, 1 percentage point. Everyone thought, well, that isn't very much. And you sort of almost don't notice the relatively small, although it's probably, depending on your income, 20, 30, £50. But accumulated across the whole country, it became a very large saving for the government. Remember, the government, or arguably at least, sees these things as like a negative tax when you're giving it back, which they don't normally do. So I think a 2% and loudly hailed 2% decrease is very, very significant. And I think, especially the so-called squeezed middle classes are going to see this makes a material difference in their wage packets or salary slips each period.
Some of the figures he was saying, and are also in the statement, was something around the average worker will save about £500 a year, which
was it like an averagely well paid or an averagely paid nurse would get £520 a year extra. Policemen slightly more, but it's £10 to £15 a week now. For many people, that's really meaningful. I wonder if there's something else here as well, though, because there's been a lot of talk over the last, how many years? Since the OTS first mooted it, I guess, so probably 7, 8, 9 years, of merging national insurance and income tax, because they're kind of taxing the same thing at different rates with different bands, and it's all a bit silly and confusing. And you get people like Dan Needle publishing these kind of graphs of tax rates against income that just look utterly ridiculous and sort of progressive in the main, but sort of progresses then regresses and so on. So is there an argument, suppose in a couple of years' time the economy is doing well, the next chancellor comes in and says, well, let's drop it down to 8%, and suddenly NIC has disappeared as a separate tax. Now, if at the same time you maintain the current rates of income tax and income tax bands, then you may, in real terms, have no decrease in the actual tax take. But you've got rid of this anomaly that is this rather strange tax, which, when it first came in, was very largely a hypothecated tax. The money went into a pot to pay for, I think it was partly the National Health Service and partly pensions, state pensions. Now that's not really there at all. I mean, there are vestiges of it in government finances, but frankly, if it all disappeared, in some ways, getting rid of NICs and just letting income tax rise in real terms is almost the easiest way of carrying out that merger. Now, I don't know if that's behind this or if it's just a headline grabber, white rabbit out of the hat.
Some kind of discounts when you retirement age, take into account your paying NIC normally, you might have.
Yeah.
But
I'll let you know. But overall, I think it has to be a good thing, and it's a good thing for an awful lot of people.
Yeah, and that's coming in from the 6th of January rather than next tax year. Of course.
Are employer contributions staying as they were, or is it just employee
I don't think there's anything in there about employers, no.
No, okay.
Talking about whether national insurance should be a tax or whether we should merge or whatever, moving on to the self-employed individuals. Class 2 national insurance was the first, probably one of the first things that he actually said that I actually started writing down. In fact, no, it was the R&D first and then class 2 national insurance. So yeah, in his words, they are abolishing class 2 national insurance. In my words, I don't think that's in any way accurate. But what they are doing is saying class 2 national insurance, if it's a mandatory payment, it is being abolished. So if you're over the 12,570, if you're over 12,517 taxable profits, you'll no longer have to pay class 2. If you're between, I've got to write these things down. I do have another one. 6725. 6725 to 12,570, you don't pay anything, but you do get your credit. So your state pension is preserved if you're within those limits and you still don't have to pay. And then if you're below 6,725, you can voluntarily pay it in order to ensure you've got that national insurance credit. Hence why I say it's not really abolished, because it's still there as a voluntary payment for those who
especially the lower paid who need to preserve their pension entitlement. But that in a way seems almost counterintuitive, doesn't it? So we've got a completely regressive tax. The more you earn, the less you pay.
Yeah.
I mean, the numbers might be small, but again, it is still, was it £345 a year?
Or something. Rate, literally voluntary.
Yeah. But I mean, so those numbers compare kind of to the savings from the cuts in national insurance for your nurse and your, so if your nurse is saving 520 because then her class 1 NICs have gone down by 2%, and then losing 345 because being low paid, maybe he or she has to make up the class 2. I'm not sure, but
yes, but at the same time, I think paying class 2 is pretty much the cheapest way to get a year's credit for your state pension. So
okay, that's fair enough.
Yeah, it might still be costly given we're talking about someone on less than 6,000-ish.
Yeah.
When they retire.
Yes. Yeah. I think I'm not sure what the amount of class 3 you have to pay, because that's the other one where you can top yourself up if you like.
So we should mention class 4 as well, going down by a percentage point.
Which, and I think it would have been a bit odd to reduce employees' NICs and not
self-employed
NICs.
So
class 4 was 9% for self-employed, and it's going down to 8%. Again, with 9 to 8% doesn't feel like a massive change, but
One step closer to abolition, potentially.
Yeah, so a couple of changes on national insurance for the self-employed as well. I don't think they've released any real detail, but they are suggesting some further amendments to the cash basis. Again, this is self-employed, which I don't really deal with day to day, but they're claiming they're going to simplify and expand on the income tax cash basis for self-employed individuals.
I mean, certainly in terms of simplification, that's not a high bar.
No.
I remember when it came in, and I can't remember what the limit is or was for, you know, how much you had to be earning before you couldn't use it anymore. But it was so complicated, and there were pages and pages of legislation, and this was meant to make life easier for the relatively low earning self-employed, that they could simply self-assess their profits on a specific cash type basis. But there were so many rules around it that they were all going to go and have to find an accountant. And honestly, I know that some of the smaller one-man band accountants in Leicester, where I live now, but lived at the time and knew a lot of the people, just basically said they've got enough on their plate with their current clients. They're not going to go off and learn this new, more complicated regime. So that almost forces those people who wanted to use cash basis to go to the slightly more expensive accountants who had slightly more, as it were, critical mass in terms of learning a new regime.
Yeah.
So that was just, again, completely counterintuitive. The so-called simplification of a cash basis wasn't at all simple. So be interesting to see what comes out of this.
We shall see. But at this point, we don't know any of the detail.
No, we don't. But it'd be delightful if it's a true simplification.
Can it ever be that simple?
This could be simpler.
Yeah.
That's a given.
Those are some of the main headlines. One that will affect me slightly in the work that I do, EIS. So originally that was intended to be abolished in 2025. I think that had already been extended. I can't remember when it was initially brought in. I think it's been extended a number of times since then. But we've now got a fairly long extension. Instead of 2025, we're now 2035.
So they've added 10 years to your career.
They've added 10 years to my career.
For us,
Happy days.
Good for our clients. We changed the government we'll have before then.
Yeah, that's right, yeah. Well, to be honest, in 1935, I fully expect Nick to be Prime Minister.
I can't say I share the same aspirations.
Oh, your name isn't Jeremy, of course, yeah. So for those of you who didn't watch, Mr. Hunt made a little bit of a joke about both parties thinking seriously about making someone called Jeremy Prime Minister.
But both parties being relieved.
That it didn't happen, yes, absolutely.
That's all there is to say on AIS. They didn't actually make any changes as far as I can tell to the actual schemes. EIS is, to be fair, especially for a lot of the size clients we're talking about fairly small startup businesses most of the time. And for those types of businesses to be able to raise finance through individuals and the individuals will get significant tax reliefs, capital gains tax and income tax. EIS is the incentive for the investor, and it is valuable, I think, to a lot of businesses that we work with. So that's definitely welcome. And as Pete says, it keeps me in a job for another 10 years.
Yes.
The other thing which I have noted down here, but hadn't actually noted on the list of what we were going to talk about, was this prompt payers.
Yes, that was really interesting, wasn't it?
Yeah. That on the screen as well.
We've had that in the construction industry. We've had that for some time, haven't they? It's just whether making sure that actually, it'd be interesting if they follow through with it. Like what they're saying is, if you haven't got a history of paying promptly, then you can't even be considered for government work, which is going to be a real incentive.
I think it's going to be huge for a lot of people, those sort of large and middle-sized businesses who have a lot of small business suppliers, who they often squeeze. And I'm not saying every big business is bad, but there are a lot of businesses out there who deliberately take as long as possible to pay. I occasionally tell the story of a very well-known household name PLC group that I won't name publicly just in case I get sued, but I have been told by their advisors that they're very openly, their kind of policy is to pay their suppliers as late as possible and, frequently on the steps of the court, metaphorically at least. But so the idea of this is what they've said is that you won't be able to be considered for government contracts unless you can prove that you pay your suppliers routinely within currently 55 days. I think that they said that will go down to 45 in a year or so, and then 30 eventually. But to be honest, I mean, with a decent accounts department properly run, it cannot be difficult to simply pay invoices on a 30-day basis. If you do a 1 day a month payment of your suppliers kind of run, then unless there is a query against the actual bill for some reason, when obviously you're entitled to check, in general terms, why on earth shouldn't it always be paid within 30 days or so?
Yeah. Unless the governments aren't paying their bills on time, they're saying, so why shouldn't you pay?
Yes, absolutely. And it's an interesting one because I think the problem with policing, all the various laws there have been, and the statutory interest rate and so on for late payment of bills, the average small businessman would turn around and say, yes, but if I'm getting work from, and let's name someone like Tarmac, because I don't think they can sue me if they're in liquidation, but just as an example, suppose a small businessman said, I'm just not getting paid by Tarmac, and I've written and I've phoned and I've begged and I've pleaded, and now I'm taking them to court. And what happens is, with luck, he gets paid the money he's owed, probably doesn't get his legal costs back, and never gets any more work from them again, because they just say, well, he's a troublemaker, or she is a troublemaker, we don't want to work with them anymore. So this actually becomes a little bit more self-policing, and doesn't require the small business person themselves to put their heads above the parapet and lose future work from that source, that customer, that client.
Yeah, it reminds me actually, way back when I worked in audit, we had a client who basically did electrical connections and things like that. And so long ago, I can't remember who their customers were, but that's the type of business who certainly could be affected by government-based contracts, but they were always chasing cash flow. So arguably, this type of change with a company that is in financial difficulty, struggling to pay its debts as they fall due, this change could create them losing contracts, therefore not being able to actually pay the debts that they already have, and therefore actually going under.
Well, yes, there could be a negative, but I think the intentions are good, and the way that they're trying to do it, I think, is sensible. And if you are talking about government contracts where that person is being paid regularly and on time, I mean, yes, I agree. If that company also has other big clients who are not paying on time, but then the point is, the bigger the person who's potentially not paying on time, the more likely they are to have government contracts or to be seeking government contracts. And especially if the government turns around and says, and they'll review all current suppliers as well, which they haven't really talked about yet, but if they just turn around and said, okay, either we review you all, or you're all on annually renewable agreements anyway, so we effectively do the review when we choose whether or not to renew the agreement. So either way, I understand you're quite right. There may be a couple of people who get caught out, particularly at the beginning, but it should have effectively a trickle-down effect.
Interesting to see how they get this information. To kind of the payment.
I suppose you could actually look at bank statements, couldn't you?
It'd be quite involved. It'd be quite a bit of DD required. The framework, but it'd be worth it.
And that would obviously come off the price of the contract.
Yeah.
But once they've got a procedure established, I suspect it will be fairly straightforward.
Yeah. I think those are the main things that kind of he did say. So the next question is, what didn't he say? What were we hoping for? Why was I so excited about this budget? And I'm now talking in a deflated tone.
I didn't realise you had another one.
It's all the same tone. It just sounds so different in my head. That's all.
If we hadn't had the results in the recent by-election, maybe we would have seen arguably very little any tax cuts. And they're preparing it. I think it's fair to say they're preparing for spring budget manifesto. You know, what they're going to try and bring in the spring budget, and what's going to go in the manifesto. Manifesto, I feel, probably be the corporation tax cuts. You know, this time, 2 years time. So this was always, I think, going to be a little bit of a kind of bit of plaster just to kind of start. Election.
I mean, certainly our starting point last week when we did our little sort of broadcast about what we thought might happen was how much legroom has he got? And I'm genuinely surprised, because I've also looked at the tables of numbers in, or we used to call the red book, but it's green. And you know, we're getting those Nick's cuts are getting to £8 or £9 billion a year, but about 2 or 3 years down the line in terms of cost. And I'm struggling, to be honest, to see where the positives, as in, I don't mean positives in business, where the balance is. So I think this is a little bit of a spend budget rather than a tax and spend. So I think, and obviously at this stage in the electoral cycle, and it's one of those things that is an unfortunate consequence of our particular form, possibly all forms of democracy, but at this stage of the cycle, yes, of course, they're ramping up to make people feel good this time next year, if not rather earlier. Be interesting to see if they do go for a winter election again, because I think the general election on the 12th of December 2019 was very, very unusual. I think it had been decades, if not hundreds of years, since there'd previously been an election outside that general sort of May through September
I think the maximum
period.
14 months maximum we've got before the next election.
I mean, yes, there's obviously a bit of leeway over the 5 months, isn't there? Because people are talking about January 25.
Yeah, that's a maximum, I think, 14 months. And everyone's saying 12 months. We'll see what polls say. And
so we've already talked about EOTs, that because of the consultation, we thought maybe we'll see some possibly minor changes, which didn't happen. You were heavily involved, Pete, in the consultation, which I think ended in July, on stamp duty modernisation.
Yes. So that was one where, in terms of timing, I felt, by November, they'd had 3-4 months to consider. And again, when they put these consultations out and make some suggestions, you almost feel those decisions are largely made. We are going to do that unless industry comes back, the consultation comes back with some compelling reasons why not. And certainly most of the stuff in the stamp duty document, I think people were mostly fairly positive about, because that itself followed a year-long consultation with a sort of steering group of about 25 or 30 of us around the country and from different types of firms and industry and so on. So there was a feeling that it would be possible for them to announce a brand new regime for taxing transactions, transactions involving shares and what are currently chargeable instruments of one sort or another. Much like Nick's comments earlier on about full expensing, one of the more interesting pleas in terms of lots of people putting it into their responses is that if you're going to have a new tax on this type of transaction, please call it anything but stamp duty. Call it share transfer tax or instrument transfer tax or something, because that would describe what it does, and it would stop the utter confusion with people nowadays talking about stamp duty, and nobody can tell until you actually get to the subject matter whether they're talking about what is now stamp duty or what is now stamp duty land tax, which of course is a property transaction tax, which sensible people like Scotland call it land and buildings transaction tax. The Welsh call it land transactions tax, and we still call it stamp duty land tax, which means everybody calls it stamp duty and nobody knows what they're talking about.
That's always the problem when you're having a conversation with the client and you're sort of saying, well, stamp duty will be payable on this, let's say if it's a partition demerger, and they're thinking, oh, we've got rates, what, 3%, 5%, what's the rate?
But even the revenue have the same problem. Their manual is called the Stamp Taxes on Shares Manual, SGSM. So change it, please change it. But there were lots of very interesting things said in the consultation. To be fair, the consultation document didn't have that many kind of part-made decisions in the same way that the EOT conduct. And because I think what's going to be given out is, a brand new chunk of legislation, much like we did in 2003 with SDLT. There was a brand new tax, and it was all in Finance Act 2003, and mostly still is. So I'm I half hoped they would at least be saying something like, yes, the draft legislation will be released in December or January or something, because I think the issue with what's going to be a brand new tax is that it's not going to be a few pages of amendments to something that exists. Even where the current treatment of things is to be preserved, the legislation will likely be very differently phrased, because we've got a new way of looking at legislation. I mean, strictly, some of the stamp duty rules are still in sort of Finance Act the Stamp Duty Act 1890, and obviously some of it goes back to 1930s, 1967.
Now,
yeah. So, there's going to be maybe 40 or 50 pages of legislation that people are going to need to pore over and work out how they all interact with each other, and how whatever's going on compares to what we had before, and whether it does what the government said it was going to do. And that does take time. It takes a lot longer than when you just get a couple of pages of legislation to make some specific amendments.
Inheritance tax, I think a lot of people thought something was going to happen. Looking at the predictions that we've had at the start of this week, I did feel bad. We did our predictions podcast on Friday, and then I saw so much press over the weekend at the start of the week, thinking, I didn't think of that.
Well, you did. I thought you said there was going to be a rate reduction.
I did, yeah. On IHT, that is one that I predicted.
And my prediction was that they might increase the nil rate band instead, because it hasn't been increased for so long. So all this speculation over the the early part of the weekend, I think it was that the rates would go down, and therefore that you'd be right and I'd be wrong.
I was so confused.
And then number 10 kind of scotched the rumour. So I don't know if Jeremy Hunt was kind of floating it by a judicious leak, as it were.
So that's inheritance tax and capital gains tax. I mean, I can't. We've been talking for at least 3 years to clients. Every budget. Are they going to do anything with CGT? I mean, the last major thing that they did was they made entrepreneurs relief, business asset disposal relief. So one they did rename, not necessarily entrepreneurs relief. It's easier.
So then we started calling it bad relief, and guys from the Treasury used to get really upset on some of these conference calls. But yeah, I mean, that was an odd one, because again, the government sponsored or requested a review of capital gains tax and certain aspects of it from the Office of Tax Simplification, late lamented. And one of the things that was mentioned was it may not raise much money, but presentationally, politically, it would be good. I mean, I think we talked a little bit on Friday about how maybe it's more of a potential Labour thing.
I think the man said they're looking at it, but still, they've even said they don't want to necessarily equalise it with income tax rates. But
no, absolutely. But I think in terms of who pays it, so the people who pay capital gains tax and who are impacted by things like business asset disposal relief are, if you like, a lot of small business owners when they sell their businesses. And to that extent, if a lot of those are, as they may well be, being entrepreneurial, might be more likely to vote Tory. I'm trying to be a little bit careful, and I'm certainly not making a political statement here, but if you like, the Tories might see the self-employed as largely their heartland, their core vote. So to increase the tax that those people would pay when they sell the business they've spent a lifetime building up might be counterproductive in vote terms.
And when you were just talking about the aligning with income tax, that was the OTS that suggested that, I think, 3 years ago, which is why we've constantly had these concerns. And
for many years, that alignment was there.
Yes.
It's just that we had things like business asset disposal relief, entrepreneurs relief, business asset taper relief. When I was growing up, retirement relief. Still remember that. And so in effect, as particularly business owners or trading business owners didn't pay the full rate.
Just so that, some of you might have been joining us last week, so I thought I'll share our predictions, and more importantly, where did Pete and I go wrong, and where you should never listen to us again in future budget predictions. Of course, if we're talking about actual tax advisory, certainly welcome to listen to us. But how well did we do on our predictions? EOT announcements?
None.
None.
So, question mark, are we right?
Oh, I think you were right on that
Because
one, Pete.
Well,
You said no changes. I said, oh, they're changing income tax.
well, I think the point is that there wasn't an announcement. We both thought there would be announcements about EOTs,
Yeah.
and there were not.
Yeah.
Um,
I don't think either of us thought there'd be stamp duty. We thought that's far too big of an overhaul to put through.
Yeah,
We got that one right.
yeah.
SDLT, yeah, that's one we haven't talked about. There was quite a lot of talk, I think, in terms of SDLT, that they might change how the mixed use rules would work. So at the moment, if you have a mixed use property, by that I mean residential and non-residential in one, you pay non-residential rates. So the suggestion was, are they going to change it so that you apportion it? So you pay residential rates on the residential bit, non-residential rates on the non-residential bit.
Mm-hmm.
Nothing at all about SDLT, so both wrong again. 1 for 3, both of us at the moment. Capital allowances.
Arguably both right,
Yes.
but they didn't take into account your question or query or your plea. Perhaps because you should have put a question mark instead of an exclamation mark, then they might have taken more notice.
Looks down to grammar, doesn't it?
Yeah.
Don't stop.
Yeah, absolutely. I thought there might be some kind of announcement about maybe reviewing the effectiveness of incorporation relief, which was really trying to just put a little bit of controversy into the list because, you know, we felt that the Chancellor's room for manoeuvre was sufficiently low that it might be fun to just put something relatively unlikely. And so I'm not surprised it didn't happen, but I guess on the basis that Nick's silence meant he didn't think it was going to happen. He was right and I was wrong.
Right. Yeah, I mean, there's been an awful lot, and Spotlight 63 being one of them, about certain tax avoidance schemes on incorporation, but I can't honestly remember the conversation we had last week, but I think the point was, or my point was, incorporation relief is a valuable relief, because if you're converting from a sole trader or partnership to a company, you're not getting cash out of the business. That's not a sort of an exit event. Most incorporations are for commercial reasons, and therefore being able to do that without incurring significant tax charges is quite important.
So I was right to say there would be no changes to corporation tax rights, and you was wrong.
I thought maybe, just maybe, 50,000 for, I mean, even the a lot of small companies that, you know, Jerroms Act for 50,000 is not a very high limit, is it? So,
and we've already talked about us both being wrong on inheritance tax.
Yeah. I didn't actually add all of that up, but I think it's about honours even, if I'm honest.
Yeah, I guess so. But it was quite a fun little exercise. And of course, it's possible that if we extended this list to what might happen between now and the actual publication of a full-scale Finance Act 2024.
Yeah.
I mean, it's interesting because normally in the days when there was an actual budget statement, fiscal event, as it were, in November, there would be the publication of draft legislation in December. Now, I went back and checked, and of course, there was quite a lot of draft legislation published in July for what they call the Finance Act 2023/24 or whatever. So it may be there's no further stuff to be reached, because normally they would announce it, or they also say, and on this date will be announced, or you know, releasing the consultation documents on this, that, and the other, which is what happened with the OTs, for example. So interesting that I suspect nothing much more will happen fiscally until March, usually, when there's perhaps another fiscal event, whatever that might be. Maybe sometime before that, they will actually publish an entire finance bill. But yes, in many ways, a bit of a damp squid, even though we've managed to spend, you know, 50 minutes talking about that damp squib, but not as much happened as we thought might, given the activity that there's been already this year, like the consultations.
Yeah, I think that's the point. I mean, some of the positive things are less changes, more extensions of what we already have. Yeah, I think overall there is some, certainly for sort of the individuals on sort of reasonable salaries of 35,000 or so, at least they're slightly better off by around 500,000 if only £500 a year, and possibly slightly more if you're earning slightly more. So not the worst outcome, I don't think, but as tax advisors, I think we were hopeful for slightly more interesting changes, shall we say.
So I suspect they will come. There will be a new tax on transactions, and there will be changes to never go through a consultation process and go, everybody says it works fine, let's not bother. It's just never happened, has it? So
well, I think in that case, all that remains is for me to thank everybody for joining us today.
yes, thank you so much.
Thank you.
Hopefully you've at least found it interesting and informative. I know we'll be releasing more information, more detailed information, I think tomorrow morning as well. So do look out for that. And I guess we'll see you at the next budget event.
Or the next event we put out on LinkedIn.
Oh, we've got lots of I've got lots of things in the pipeline for that.
Absolutely. So keep watching this space. Thank you.
Thank you, Ron. Thank you.